Next, we want to talk about project-based cost of capital. We have been making the assumption along that the leverage of the firm and the risk of the project are the same, so they match these characteristics for the firm as a whole. That allowed us to assume that the cost of capital for a project matched the firm's cost of capital. But firms with more than one division, and particularly conglomerates, rarely use a single company WACC to evaluate projects. A project's cost of capital depends on its risk. When the market risk of the project is similar to the average risk of the firm's investment, then its cost of capital is equivalent to the cost of capital for a portfolio of all the firm's securities. General Electric, for example, is a large firm with many divisions that operate in completely different lines of businesses. Projects in healthcare divisions are likely to have different market risk than projects in air transportation, equipment, or appliance division. Projects also can vary if they have different amounts of leverage. So in this section, we're going to talk about calculating the cost of capital for a project's cash flows when the project's risk differs from that of the overall firm's risk. Now, we're going to look at a simple example here. Suppose you're working for H.J. Heinz. Now, I wish to let you all know that for the last few years, Heinz has not been an independent company. It is owned by Berkshire Hathaway, which is certainly a company that can't have one constant WACC. It's in so many different industries, certainly in food and in real estate and insurance and in transportation. So we're going to just look at Heinz, thinking about having a beverage subsidiary. Currently, Heinz's WACC is 6.6%. Beverages would be a new line of business, so the systematic risk would differ from the systematic risk of Heinz's current business. So the assets here should have a different cost of capital. So we need to find the cost of capital for the beverage business. Assume that the risk-free rate is 3% and that the market risk premium is 5.4%. How would you estimate the cost of capital for this type of investment? Well, the first step is to identify a company operating in Heinz's targeted line of business. Coca-Cola is a company that is a well-known marketer of beverages. In fact, that's mostly all of what Coca-Cola does. So the cost of capital for Coca-Cola would be a good estimate of the cost of capital for Heinz's proposed beverage business. I wish to also point out that not only does Berkshire Hathaway own Heinz, but it has a substantial investment in Coca-Cola. Now, many websites are available that provide company betas, including finance.yahoo.com. So suppose you visit that site and find that the beta of Coca-Cola is 0.4. Well, if you actually visit that site, which I did in August, you will see that actually in August it was 1.01. So it was not 0.4, but we'll just assume for our paper right now, project, that it is 0.4. With this beta, the risk-free rate and the market risk premium, you can use the CAPM to estimate the cost of equity for Coca-Cola. Now, suppose Coca-Cola has a market value ratio to debt to assets of 0.58, and that its cost of debt is 3.8%, and that its tax rate is 28%. So using CAPM, we would see that Coca-Cola's cost of equity is 3% plus the beta times the market risk premium, which gives us 5.8%. To get Coca-Cola's WACC, we don't have any preferred stock. We use the rate of equity times the equity percentage, which is 42%, plus the rate of debt times 1 minus the tax rate times the debt percentage, and that gives us a 4.0%. So the correct cost of capital for evaluating a beverage investment opportunity is 4.02%. If we had used the 6.6% cost of capital associated with Heinz's existing business, we would mistakenly have used too high a cost of capital. That might lead us to reject the investment even if it truly had a positive NPV, 4%. Now, what about if we're using external equity? That may be more costly because issuing new stock or bonds carries a number of costs. What we need to do is just treat the issuing costs as what they are, cash outflows necessary to the project. No reason to treat a project finance with new external funds any differently than a project finance with internal funds, like retained earnings. So we can incorporate this additional cost as a negative cash flow in the time zero or whenever we would incur it in the NPV analysis. So here's an example using costly external financing. You're analyzing Microsoft's potential acquisition of Yahoo in February 2008. Microsoft plans to offer $44.6 billion as the purchase price for Yahoo, and it will need to issue additional debt and equity to finance it. The issuance cost is $1.5 billion and will be paid as soon as the transaction closes. So this will be a year zero. You estimate that the incremental free cash flows from the acquisition will be $1.8 billion in the first year and will grow at 3% per year hereafter. What's the NPV of the proposed acquisition? Well, we get the present value, the free cash flows, $1 billion. Use the required return of 7.1%, which we see here is the cost of capital for Yahoo, and the growth rate is 3%. So the NPV of the transaction is the present value, that growing perpetuity, subtracting out the purchase cost and the additional transaction cost of using the external financing. So therefore, we pay the money here to buy it, plus the cost of the financing. Those are both year zero negative numbers. The $1.8 billion divided by 0.071, the required return minus the growth rate of 3%, is minus $2.2 billion. We don't need to adjust. We can just whack for the issuance cost of debt and equity, just subtract the issuance cost from the NPV to see that this is a negative NPV project. We do not recommend Microsoft acquiring Yahoo if these are the relevant costs. Thanks.